Welcome to this complimentary presentation on the economic influences on real estate development, brought to you by the Falby Institute for the Development of Real Estate. We hope you enjoy it. Hi, I'm Wayne Falby, and I'll be narrating the presentation. In it, we'll examine the effects of fiscal and monetary policies on the real estate development industry. Let's get started. First, let's take a look at the underlying elements of economic policies. There are essentially two. One is fiscal policy, the other is monetary policy. Fiscal policy is the province of the White House and Congress, or the executive and legislative branches of government. What those branches do is they regulate taxation by either increasing or decreasing it, and they can regulate government spending by either increasing or decreasing it. And we'll take a look at the effects that those kinds of actions have on real estate development. The other underlying branch of policy, economic policy, is monetary policy, which is governed by the Federal Reserve System, or the Fed. And while they have many tools available to them, there are two in particular: interest rates and open market activities. Open market activities consist of a number of things, but one of the principal ones is the ability of the Fed to go into the marketplace and either buy or sell U.S. Treasuries. When they buy them, they pump money into the economy. When they sell them, they pull money out. So depending on whether the Fed reads the economy as being overheated or too sluggish, they can take either of those measures. Let's take a look at specific actions or activities. Government spending can be supported by taxes. Now, to do that, if they increase spending, they've got to raise taxes. When they raise taxes on the taxpaying public, it has certain effects. One of those effects is the incentive to produce. If your tax bill, your rate of taxes, is higher and higher, there's less and less incentive to work harder and make more money, because the more money you make, the higher the tax bracket you move into. And eventually, you're working very hard, but you're taking home very little. Another effect it has is on discretionary income. Discretionary income is what's left after you've paid your taxes and used up your disposable income, which is the income you use to pay your regular bills, such as rent, food, clothing, and so forth. The more the tax bite increases, the less discretionary income you have. The less discretionary income you have, the less consumer activities you can engage in, such as buying homes or renting office space. The government can also print money to support its spending habits. Here's the problem. If the government prints more money, it just simply increases the number of dollars floating through the economy, but the amount of goods and services which those dollars chase remain unchanged. To put this in an example, if an apple costs $1 today, and tomorrow the government doubles the amount of money that they've printed, and that is in circulation, the seller of the apple, in order to stay even, has got to charge $2, and we call that inflation. A third possibility: the government simply borrows money to support its spending habits. Well, the effect of borrowing more money results in the issuing of IOUs. The IOUs are called treasury bills, notes, or bonds, depending on the duration of that treasury. The shorter term ones are bills, and intermediate terms are notes, and those that are long term are bonds. The problem with that is, when you issue enough IOUs, is there not a point where the creditors, those who are buying those IOUs, begin to lose faith in your ability to repay it because you are so far in debt? When that happens, do they stop lending? Do they stop buying those IOUs? And when they stop buying those IOUs, how does the bankrupt, if you will, pay bills when they can no longer secure funds? And last but not least, there's always the possibility that the government could say, money is being made in the private sector. There's a profitable bottom line to business. Let's just take those businesses. And that's happened. It's happened in this country, and it's happened in other countries. And what we've seen when that happens over any sort of lengthy period of time is that the incentive to produce, to be entrepreneurial, to take risks, goes down. Well, why would I do that if I'm going to build a business that the government's going to take at some point? And productivity goes down because when you're working for the government, doesn't matter what your job is or was in the private sector, you're now working for the government who owns the company. So there's no real incentive to produce. Essentially, you can't get fired. So why work? Why work hard? And when that happens, profitability falls off, and wasn't it the profitability that drew the government to nationalize the business in the first place? Looking at the spending policies of government versus that of the private sector, it's easy to see that the comparisons are certainly vivid. The government, for example, does not have any budget constraints. They can print and borrow whatever they have to do to get their hands on money. They don't have to stay within a budget. They don't have to follow a budget. They can make a budget and they can promptly ignore it. The government can create money out of nothing, paper and ink. The government can borrow without having to put up any collateral or without having any direct recourse against the government. If you borrow, you've got to put something up as collateral. Your house, for example, on a mortgage, your business or parts of your business for a commercial loan. And of course, the government can change the rules anytime it chooses to do so. The private sector, of course, has to generate income from sales, rents, or services. Bottom line. The private sector has limited borrowing capacity. And you must repay your debts or you're going to be sued, you're going to go into bankruptcy, there are going to be foreclosures. It's not going to be pretty. And you have to, at the end of the day, have generated profits or you're going out of business. So the bottom line then is that in a capitalistic system such as we have in the United States, with its free market philosophy, provides an environment in which hard work and risk-taking can be rewarded. Now, you take risks, you may suffer the consequences, but without risk-taking, there is no reward. So what is the effect of the expansion of government spending in the private sector? What does it do to productivity and the opportunity to succeed? It dampens it, doesn't it? What happens to your cost of capital? It goes way up because the government is playing the rules, setting the rules. And if the government says, we, the government, have borrowed so much money that in order to get more, we're going to have to raise the interest rates we pay, that will raise your interest rates too, and your cost of capital will go way up. Purchasing power of your dollars will go down. If they double the money supply without doubling the amount of goods and services, it'll go down, and the health of your private enterprise ultimately fails. And those are some hard things to think about as we move forward. And with that, I thank you for your time and attention in viewing this brief introductory program on the effects of government economic policies on your business operations. We hope you enjoyed it. It's been our pleasure to be able to bring these programs to you. For information on our other programs concerning the real estate development industry and the functions of the developer, please review the information on our website, falbeinstitute.com. You also may find our blog to be helpful, and it can be accessed from the website. Thank you.